Global stock markets fell earlier last week. Interest rates fell as investors worried government efforts to reduce inflation would force their economies into recession. Despite a spate of negative data releases in Europe and the United States, several bankers' speeches have become more pessimistic. More are likely last week when the head of the European Central Bank, the Federal Reserve of the United States, and the Bank of England attended a central banking gathering. According to data released on Tuesday, consumer confidence in Europe fell to a negative 22-month low in June. Still, numerous Fed members predicted quicker rate rises, citing the need to contain uncontrolled inflation. For the best and latest crypto and finance videos, make sure you subscribe to my channel and hit the bell icon to be the first to get the latest updates and news. Consumers' fear of a recession leads to positive equity returns. Following a string of poor consumer confidence statistics from Europe, those US results caused vital Wall Street declines, sending the S&P 500 and Nasdaq indexes down 2% and 3% respectively. This weekend momentum continued last Wednesday, with the Asian ex-Japan index falling 1.4% and the Pan-European share index falling 0.3%, halting a 3-day gain. 10-year bond rates in the United States and Germany fell 5 to 6 basis points, with the former falling more than 30 from their mid-June highs. Citibank warned clients that a drop in consumer confidence usually leads to a recession, following annual inflation rates varying from 7.5% to 7.9% across Germany. The country reported an 8% in June, up from 7.9% in May. As long as the growth inflation question marks remained, Paul O'Connor, head of Janus Henderson's multi-asset division in London, forecasted stormy markets. The difficulty is that the degree of inflation is so serious in so many places of the world, and we are still a long way from the central banks declaring the work done, O'Connor explained. We will surely see growth downgrades this summer, but we will also see an increase in the sense of recession risk, and I don't believe markets are completely reflected their prices. On Tuesday last week, sentiment improved on reports that China was relaxing quarantine requirements for arriving travelers as part of its zero-COVID goal. While several sectors of the Chinese stock market, including genuine estate, extended gains on Wednesday, the euphoric impact of the news faded. Chinese blue chips, which had set 4-month highs on Tuesday, fell 1.5%, while Hong Kong declined 2%. Markets typically respond to this type of news, said Carlos Casanova, senior economist at UBP in Hong Kong. To be sustainable, we need to see these initiatives translated into genuine reopening. Inflation fears affect oil and the dollar. Inflation fears have been heightened by 3 consecutive days of oil price gains, which have taken Brent crude futures above $117 per barrel. The market is caught in a tug-of-war between a deteriorating macro backdrop and the approaching possibility of a recession, versus the greatest fundamental oil market set up in decades, if not ever, RBC Capital's Mike Tran told clients. On Wednesday, the OPEC Plus crude exporters began a 2-day meeting. Nonetheless, a significant policy shift appears unlikely, with UAE Energy Minister Suhail Al-Mazroui already indicating that his country is nearing capacity. Market concerns have fueled a fresh rush of the dollar, which has pushed it to a 1-week high versus a basket of currencies. The euro dropped 0.6% against the dollar overnight, but was steady at $1.0514, while the yen at 136.13 per dollar was not far off last week's 24-year low of 136.7. Consumer spending and stock returns. We investigate the information quality of consumer credit and debit card spending in explaining future stock returns using a unique data set of individual transaction-level data for a population of U.S. consumer-facing stocks. According to our research, consumer spending data predicts several metrics of a company's future profit surprises up to 3 quarters in advance. This predictive value remains substantial in our sample of consumer discretionary companies, both large and small cap. The kind of transaction data used, credit card, debit card, or both, has no effect, though the association is greater in the small segment, where informational asymmetries are more prominent. Based on this research evidence, we created a straightforward long-short strategy that invests in the top and bottom statistical relationship of equities determined by our real-time sales signal. After controlling for the well-known sources of systematic variables, the strategy provides statistically and economically significant yearly returns of 16% net of transaction fees. Simple optimization efforts to generate tangency, mean variance, efficient factor portfolios provide an optimum factor allocation that gives our long-short portfolio more than half the weight. According to our results, consumer transaction level data can give a more accurate and long-term indicator of a company's growth potential and future earnings. Eurozone consumer confidence. Consumer confidence assesses consumer trust in economic activities. It is considered a leading indicator since it forecasts consumer spending, which is critical for overall economic activity. The figure is based on a survey of 2,300 Eurozone consumers who were asked to rate the country's economic prospects in the coming year. Higher figures reflect increased consumer confidence. A higher than expected result should be seen as good or bullish for the euro. In contrast, a lower than expected value should be seen as negative or bearish for the euro. According to the Euro Area Economic Sentiment Indicator, the Euro Area's Economic Sentiment Indicator dipped to 104 in June 2022, the lowest since March of last year, contrary to estimates of 103. Sentiments dropped among retailers, consumers, and manufacturers as high prices and increasing interest rates weighed, but it improved among industrials and service providers. Meanwhile, the Economic Uncertainty Index increased from 23.4 to 24.8, while the Employment Expectations Indicator declined from 112.6 to 110.9. Sentiment fell in the 5 main economies of the EU, most significantly in the Netherlands, negative 3.6, Germany, negative 1.9, and Spain, negative 1.9. According to the National Association of Realtors report, existing home sales in the United States dropped again in May. According to the NAR, sales fell 3.4% to a seasonally adjusted annual rate of 5.41 million units. April sales also decreased, which is the lowest level since June 2020 when the COVID pandemic started. Despite the 4th consecutive monthly drop in sales and deteriorating affordability, the housing market stays fairly strong, with properties on the market for a record low 16 days, according to the National Association of Realtors. Thank you for taking the time to watch this video. Don't forget to smash the like button and the subscribe button to be first to watch the videos that follow this one, and for more crypto, Web3, NFT, and finance updates and news.